In this video we are going to talk about Dividend Aristocrats. So before starting, please like this video and subscribe to this channel for future updates. Since the financial crisis, the stock market has had its worst week. A flight to safety has caused some investors to exit the market. Other investors, on the other hand, are flocking to quality. These are the times when dividend stocks excel when it comes to equities quality. J.P. Morgan Chase, NYSE, JPM, Morgan Stanley, NYSE, MS, and Goldman Sachs, NYSE, GS, have already forecasted that the coronavirus will wipe out corporate profitability growth in 2020. If investors can't rely on capital gains from their stocks, they turn to dividends to improve their total return. However, not all dividend stocks are created equal, just like any other investment. Dividend Aristocrats are among the top dividend stocks. A corporation must have at least 25 consecutive years of dividend growth to be considered a dividend aristocrat, not just issued a dividend. These businesses have a track record of surviving market turmoil and generating strong results. There are currently just 64 of these businesses. We'll show you 10 dividend aristocrat stocks you can buy right now in this video. Number 10, AT&T. AT&T is an American telecommunications company. During this correction, AT&T, NYSE, shares have followed the course of most other stocks. There isn't any more, but there isn't any less, either. Despite this, the stock has remained in the black for the past 12 months. Telecom stocks are good defensive investments, which is one of the reasons I favor AT&T stock right now. This means that they function well regardless of the state of the economy. Certainly, AT&T anticipates a boost from the 5G revolution, as well as an increase in retail sales as a result of the launch of 5G solutions from Apple and other companies. Both of these situations may result in less profit for AT&T than the company had hoped for. Despite this, the corporation has worked hard to diversify its revenue streams. In 2018, AT&T paid $33 billion for time content. Warner's AT&T has entered the streaming wars with this new corporate entity, Warner Media, which includes HBO. Number 9, McDonald's. McDonald's is a fast food restaurant chain, MCD. Will the coronavirus inspire people to eat less fast food? If you're going to disregard McDonald's, NYSE, MCD, you should think about this question. Before the market correction, the company had made a great year-to-date gain of over 10%. When a virus like the coronavirus strikes, though, it could prove to be a vindication of the company's decision to engage with food delivery apps. While I've always been skeptical of having McDonald's delivered, the momentum speaks for itself. Is this really a better option? Who knows, but the reality is perspective. To be fair, there were certainly some other restaurant stocks that were better than MCD prior to the market correction. And, in the long term, those may out to be superior. However, as a short-term trader, the safety and near certainty of the company's dividend are too excellent to pass up. Number 8, Lowe's. Lowe's is a home improvement store. Lowe's, NYSE. Lowe's had a fantastic year in 2019. In the face of competitive pressures such as those posed by Home Depot, the corporation has managed to redefine its business, NYSE, HD. To that purpose, the corporation has been attempting to alter both its physical footprint and its online presence. According to the company's most recent earnings report, it still has some work to do. The company's sales fell short of the FactSet forecast. But, more importantly, it was mostly driven by brick-and-mortar retailers. In terms of e-commerce, the company is about a year behind Home Depot. Home Depot, on the other hand, only saw signs of those efforts paying off in the most recent quarter. Number 7, Medtronic. Medtronic is a medical device manufacturer, MDT, Medtronic, NYSE. MDT, is a company that operates at the crossroads of two rapidly rising industries, healthcare and technology. Medical devices are one of the areas in which the company is active. This has traditionally been a favorite of bullish investors, and it appears to be the same right now. Prior to the market drop, MDT stock had gained more than 25% in the previous year, compared to the industry average of 10%. The corporation produced a mixed financial report, including revenue shortfalls. The coronavirus may have an influence on the company's profitability and revenue in 2020, according to the company. However, stock prices were largely unaffected. It's possible that this is due to Medtronic's long-term commitment to digital surgery. This combines healthcare and artificial intelligence, AI. Only 2% of current surgeries in the globe are conducted with the help of robotic equipment, therefore it's an area with a lot of room for expansion. MDT stock has a dividend yield of 2.21% and pays out a $2.16 per share yearly dividend. Over the last 3 years, the company has increased its yearly dividend by 6.07%, marking 42 years of dividend growth. Number 6. ABBV. ABBV, recently reported earnings that exceeded expectations on both the top and bottom lines. On revenue of $8.70 billion, the company earned $2.21 per share, EPS. Analysts expected earnings per share, EPS, of $2.19 on revenue of $8.68 billion going into earnings. ABBV has a medication under development to treat the coronavirus. However, ABBV's long-term thesis is that it has a strong pipeline of cancer and antiviral medications. It also has a substantial cash flow. Both of these are critical because the company's patents on Humira are set to expire. With Humira, the firm is already experiencing atrophy. In the first quarter of this year, European sales fell by 23%. Humira sales, on the other hand, increased by 7% to $3.2 billion in the United States. Number 5. Walgreens Boots Alliance. Walgreens Boots Alliance, WBA. The stock of Walgreens, Nasdaq. WBA, is off to a shaky start in 2020, but now could be the time for it to shine. First and foremost, the company's revenue is increasing. Between 2016 and 2019, the company's total revenue increased at a CAGR of 5.4%. And the company's pharmacy business was primarily responsible for this revenue. This appears to be a key driver for the company in 2020, with the pharmacy expected to contribute $84 billion to the company's fiscal 2020 revenues. That would make up nearly 60% of the total. It's reasonable to expect Walgreens to benefit from ancillary sales as customers fill prescriptions and stock up on other items. Number 4. Walmart. Walmart is a retailer that sells WMT. Even though Walmart, NYSE, WMT, failed both earnings and revenue projections in the release of its fourth quarter results, the stock rose in February. One reason investors may have overlooked the bad news is that the company's net income in the fourth quarter was much higher year over year. A decrease in profits is never a positive thing for a firm. And investors had to be expecting that a respite in the US-China trade conflict would help Walmart stock. The coronavirus, on the other hand, must now be causing supply chain issues. Before this week's market slump, the stock had been essentially flat for the year. The stock is now down more than 10% for the year. However, as with many of the equities in this presentation, decreased earnings are expected in 2020. It's the dividend that counts with these stocks. Walmart, in particular, is a strong performer in this area. Number 3. CocaCola. CocaCola, Co., is a beverage company based in the United States. The following summarizes my case for Coca-Cola, NYSE, Co. If Warren Buffett thinks it's good enough for your portfolio. Buffett's investing style, however, is not for everyone. And, with a corporation that appears to be in the crosshairs of healthy new alternatives, some investors will require more certainty than just a dividend. While Coca-Cola expects the coronavirus to have an impact on first quarter earnings, the company is confident that the impact will be overcome throughout the course of 2020. There is no doubt that Coca-Cola is exposed to China, which accounted for 14% of the company's revenue in 2019. However, you buy Coca-Cola stock for its dividend, which is rock solid and was just boosted in February. Number 2. Procter & Gamble. Procter & Gamble, PG, Procter & Gamble, PG, is another stock that is doing well as the market digests the implications of the coronavirus, NYSE, PG. The company's debut of a new brand that disinfects without wiping is a short-term driver for the stock. Microban 24 is a brand of antibacterial surface cleaning products that comes in sanitizing spray and cleanser forms. Microban, unlike other antibacterial treatments for the home, offers 24-hour protection from bacteria. This is due to the fact that consumers let Microban air dry after applying it. Over the course of 24 hours, the solution releases modest amounts of bacterial-resistant chemicals. Despite the fact that the firm has stated that the launch of Microban was unrelated to the coronavirus, and there's no reason to believe it was, it will surely increase consumer interest in the stock. Number 1. Clorox. Clorox, CLX. I'm going to start with a pair of stocks that, in addition to paying a dividend, could provide investors with some capital gains in the short term. Clorox, NYSE. CLX, is gaining ground as investors predict an increased demand for the company's hand sanitizers and disinfectants. To Bloomberg, William Sussman, managing director of Threadstone Advisors, stated, "Clorox is well positioned for a short-term gain as everyone needs greater disinfectant." During the year 2020, the CLX stock was already on the rise. The stock is usually a catalyst during the cold and flu season. The stock, on the other hand, has been moving in the opposite direction of the broader market and is presently up around 10% for the year. On February 27, the stock hit a new high of $174.17. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.